We have a very exciting discussion with a very good panel of amazing clued up women that you can see with me here now. And we're going to be talking about the evolutions in the energy and emissions reporting landscape. This is across both Europe and the US. And we'll be looking at both kind of how this can affect businesses and also just how businesses can prepare for upcoming changes to any regulations and standards. So one thing just kind of before we start to kind of set the scene a little bit, why is it important that we're having this webinar today and kind of looking at these evolving regulations? Well, this is a figure that came out in CDP's most recent report. In the report that they found that out of all the kind of risk types that are considered in an organization's climate-related risk assessments, emerging regulation was the second highest risk type. And this was just behind current regulation. So climate regulation is clearly a concern for businesses right now. And it's kind of no wonder when you look out at the landscape, there's a lot of different regulations being developed at the same time, both across a kind of voluntary and a mandatory setting. And this can make it very hard, particularly for global businesses who are kind of sitting across the boundaries of a number of these different kind of where the regulations are. To really understand what they should be doing and what they should be adhering to. And the situation's kind of often been described as a bit of an alphabet soup with kind of different standards and different acronyms, making it very hard to navigate. So we are here today to kind of demystify and clarify some of that, and also look at how businesses can begin to kind of minimize some of the risks that changing energy emissions and regulations can pose. So on the panel with me today, I've got Joanna Petku, who is the Climate Change Advisor at Eurelectrics, and also Annie Chen, who is the Product Owner of Environmental Commodities with me at Flexidel. Joanna's going to kind of kick off with a bit of an overview of what's going on within the EU. She's going to look specifically at EU emission trading system and then also the Corporate Sustainability Directive. Annie's then going to fill us in a bit on US legislation. She's going to firstly cover the set climate disclosures, and she's also going to look at a couple of emerging local laws that are favouring a more granular accounting approach. And then finally, Annie's also going to touch on some voluntary reporting schemes. So we've got the RE100, SBTI, and revisions to the Greenhouse Gas Protocol. And then to close, I'm going to quickly kind of return to the core question of this webinar. So how can businesses actually prepare for these changes in regulation? And hopefully at the end, we should have some time for questions as well. So throughout the webinar, if you have any questions or any thoughts, if you just pop them in the chat panel, and then we'll get to them at the end. Great, so without any further ado, I am going to hand over to you, Joanna, to talk about what's going on in Europe.
Hi, hello everyone again. This is Joanna Petku. I work for Eurelectric, which is the association representing the electricity industry at EU level. We have members in roughly 30 European countries, and we are active across the electricity value chain from generation to distribution and supply in a nutshell. So my presentation today starts with this this statement. No, it's like climate change requires action, urgent action on multiple fronts, and accelerated decarbonization is key. Why am I saying this? Is because Europe is going through a time of increased changes. We've seen a lot of impacts of the climate change. We've seen also an energy crisis triggered last year by Russia's invasion in Ukraine, and a lot of changes and a lot of regulatory movement at EU level has come. So as Eloise was also saying in the beginning, I think there are a lot of actors in Brussels and outside the bubble saying there is a mind-numbing of climate and environmental and energy regulations that are coming, and we need to prepare for them. Of course, it's very good to regulate. It's very good to make sure that that we deliver on the climate and environmental ambitions. But at the same time, we need to be wary and mindful of the administrative burden that this is creating on companies, on corporates, on producers and customers on both sides. So if we look at EU level, when it comes to climate policy, last December, several major files were concluded. One of them is the emissions trading system, which is basically the first and the biggest carbon market existing in the world. Then there is the creation of the carbon border adjustment mechanism, and also the introduction of an emissions trading system for buildings and transport. I will discuss about this a little bit later. But there are also other policies that have been discussed, wrapped up, or are still under discussion. And here we are looking at the Corporate Sustainability Reporting Directive, the due diligence, the non-financial reporting regulations. So there is a lot coming our way. And all these are extremely important. Complementary in nature, this mandatory and voluntary disclosures help us keep track of the transition to net zero, and at the same time, it helps us tackle greenwashing, which has been a growing concern over the past years and across the globe. Nevertheless, more and more standards, guidelines, and with more policies emerging, this rapidly changing legal environment raises a lot of questions for companies, including what happens to their strategies, how to adjust them, what's the accuracy of their carbon accounting mechanisms, is there compliance between international standards, and how do we harmonize them, and so on. So this is in a nutshell what I would like to talk to you about today. And I will start by telling you something about the power sector. So the power sector is considered the success story of the emissions trading system. We know that the CO2 emissions and the intensity of carbon intensity of electricity has dropped significantly in the past 20, even 30 years, if we take 1990 as a starting point. We've seen this, and we are, as a result of more and more renewables coming online, as a result of also of the commitment of the power sector to decarbonize. And our expectations are that by 2040, the power sector will be actually carbon free. The challenge is big. A lot has to happen. We see here on the lower side of the slide that the increase in capacity for renewables expected by 2030 and 2040 is massive, is a tremendous effort that needs to happen. But this is something that we do together, both the power sector and the customers. And it's also thanks to the demand that comes from the customers that this movement towards decarbonization has started. And if I were to come with to present the emissions trading system in general and in a nutshell and its revision, I would say three things happened in December at the conclusion of the trilogues, so the conclusion of the negotiations. First, the emissions trading system was expanded. Until December, it covered roughly 40% of the emissions across the EU. Now, with the inclusion and the creation of the ETS2, so the road transport and buildings, it would include some 70 to 75% of the emissions in the EU by 2030. So we see the scope and the coverage of this regulation expanding. Then we also see strengthening on the side of the ETS1, where there has been an adjustment of the cap, so the number of allowances that can be put on the market and can be traded. This is increasing the cost of emitting CO2, so it will lead to higher carbon prices, which means that companies are incentivized to decarbonize faster and to shift to more energy efficient solutions for their operations. And then there has been also a section on preserving trust. So how will the role of financial actors be considered and their participation in the market be considered going forward. And also in a nutshell, I will briefly say that the emissions trading system, the first one, covers around 10,000 installations in electricity, like electricity generation and manufacturing. So you have steel, cement, aluminium, all these guys. Shipping will be included in the next 18 months. And then the ETS1 covers around 11K regulated entities. It's putting a carbon price on fuel suppliers, not directly on consumers, but this would definitely have an impact on consumers, because sometimes, and this is what you will see on the right-hand side, sometimes it can lead to cost pass-throughs. No? So what does it mean for business with all these changes that we have had in the system? First of all, we need to consider the time factor. These regulations have been passed quite rapidly. So do companies have time to adjust? The time is of essence. I think the time is short, so companies need to already start looking into the aspects. Then there is the preparation. So we look at the fuels that are released for consumption. Are there any alternatives? Are there any options? How do we measure? Do you have the measurement and the control systems in place to make sure that we avoid mistakes in reporting? Because all these elements have a huge reporting aspect and can lead and trigger penalties for the companies that are not reporting accurately. And then there is also what I was mentioning, the cost pass-through. If this transformation leads to an increase of costs, can this be transferred to customers, and to which extent? And I think here some of the operators are looking at their contractual obligations and what this enables them to do. So it's very hard to summarize this very big pieces of legislation in one slide. I hope I was clear. But should you have any questions, please do not hesitate to shoot them in the chat, because now I will jump to another aspect, and it's linked, another mechanism that was created by the Fit for 55 package and agreed in December, which is the carbon border adjustment mechanism. So the carbon border adjustment mechanism is what the EU calls a carbon leakage tool. So it seeks to preserve the competitiveness of the European market and to reduce exposure to the products that are coming from outside the EU, where a carbon price does not exist. So basically we want to use European products, and we want to make sure that all the imports are also subject to a carbon price, so that we can incentivize decarbonization outside Europe too. It is linked to the ETS because it mirrors the ETS allowance price, and it covers basically roughly at least similar sectors. So the sectors that are covered by CBAM are iron, steel, cement, aluminium, fertilizers, hydrogen, and electricity. It looks at the total embedded emissions, both at direct and indirect emissions, and the carbon price effectively paid or not in the third country. But it is not a cap and trade system. So as opposed to the ETS, here we are not trading the certificates. What will happen? So the transitional period starts now in October. An implementing act was adopted end of August, a bit late, if you ask me, but we understand this is a very complex topic, and the Commission did an excellent job trying to put everything together. So now, 1st of October, the reporting obligation starts. There are no expectations for companies to report before January, but the system will be set up and put in place, and there is this period when you can try and test how it works. So for the first period, this year, next year, until the full implementation, companies will have to declare, or importers will have to declare, the carbon content of their products. Depending on the sector, this is more or less an easy task. For the electricity industry, it is not the easiest, I would say, and this is due to the nature of the market. A lot of electricity is sold in power exchanges, which means that it goes via anonymized contracts. So when this happens, traders or importers into the EU do not receive the paperwork from the UK, for instance, telling them that for this unit of electricity, this price has been sold, because, well, it's anonymized. So you don't know exactly what you have bought, from where you have bought. And sometimes there are a lot of a unit can be traded several times. So it is a bit difficult to be sure what the exact carbon content of the imported electricity is into the EU. So because of this nature, the Commission went for the easy option and said you can report on default values. And these default values are either decided at national level or at regional level, based on some methodology produced by the International Energy Agency. Now, the problem with default values is that you don't have the real carbon content. It's a general average for the area. So somehow it does not encourage generators abroad to decarbonize, and it's not encouraging generators to install more renewables, because they know the electricity sold will be slapped by the same price. So if I were to highlight three issues that we have with CBAM at this stage, and that will, of course, be discussed and be addressed in the coming months, and until the regulation actually becomes effective. I would say there is a lot of administrative burden on companies on both sides, like getting the right information and the right data from the producer, from the trader, from the TSO, from everyone. So there is a need to coordinate, there is an administrative burden, there is a risk of inaccurate reporting, and there is somehow a risk of double taxation for that electricity that is traded via anonymized contracts. So that would be CBAM in a nutshell. And I'm really sorry, I've been quite slow in presenting everything. I have one more point for you today, and this is now on the Corporate Sustainability Directive, which was also been adopted recently, and it will start in 2025 with reporting for the year 2024. What we see here is the intention to have companies that have an annual turnover of above 100,000 million submit their reporting. SMEs are also included in the directive, and this would cover around 48,000 companies. So it's a big effort. They would have to report on a series of activities on the environment and societal aspects, and of course the scope 2 is real matter in this case, whereas for the ETS we would look mostly at scope 1 for power generation, scope 2 for others. Here the scope 2 is exactly into focus, and this is one of the, let's say, ways that the EU and the other international stakeholders are starting to align and to discuss the international standards. So without further ado, and sorry for the delay, I am giving the floor to Annie. Sorry, Annie.
Great.
No worries,
Joanna?
no worries, Jana.
Yeah,
Thank
over
you
to
so
Annie.
much. Yes. So as we delve into the world of mandatory reporting, it is very essential to understand that the regulatory landscape is evolving rapidly. And I want to thank you, Iona, again for explaining how this is happening in the EU. And I would like to focus now to the United States. And the key message that I want to convey here is that mandatory reporting in the United States is also on the horizon, and with it comes an increased level of granularity. So to illustrate this point, I will examine some examples, starting with the SEC climate disclosure. So the SEC has proposed a groundbreaking rule to standardize how publicly traded companies report their climate-related information. So this rule is aimed at enhancing transparency and consistency in climate disclosures among large publicly listed US companies. Under this proposed rule, companies will be obligated to disclose a wide range of climate-related information, which will include Scope 1 and Scope 2 greenhouse gas emissions. And also for some companies, it may need to disclose Scope 3 emissions if specific conditions are met. And beyond the emissions reporting part, companies must also disclose their climate-related risks, impacts, targets, goals, and they will also have to systematically manage their offsets, their RECs. In the EU, we call it guarantees of origins. In the US, they use the renewable energy certificates and manage a transition plan. So for now, this rule is in a proposal stage with a finalization of the rule expected in October 2023. It is important to note that while this proposal is still pending, it could undergo further revisions. And the exact timeline for implementing this rule is still unclear. However, it is expected to be phased in over several years, particularly for the different segments of companies that has been defined by the SEC. Moving over to the New York local law, which is a local law where we see that there is a shift towards more granularity in the regulation itself. So the New York local law 97 is a commitment by New York City to reduce the greenhouse gas emissions with a focus on buildings, which is currently a significant source of emissions in the city. The New York City Local Law 97 affects about 50,000 commercial and residential buildings, and it sets out requirements for reducing carbon emissions associated with the building operations in the city. The law imposes a series of obligations on building owners. So these include reporting on energy compliance and implementing carbon caps. It will work in a way that carbon caps will come into effect over different timeframes over the years. And when a building exceeds the carbon caps, they will receive a fine for it. So building owners must follow a conservation of measures and provide information related to their energy conservation efforts. The law provides detailed guidance on how emission limits for buildings should be calculated also. And in this methodology of how to calculate, the law also includes an hourly approach for reporting the electricity consumed on premises of the buildings itself based on marginal emission coefficients. The building owners are required to start reporting annually by May the 1st, 2025, and subsequently on May the 1st of every year, starting from 2025 for 2024. Another local law that we see is shifting towards more granularity is the Colorado H2 requirements. So the Colorado legislature has passed a bill that will create a state-level tax incentives for the use of clean hydrogen. In the law, it explains that a hydrogen producer must demonstrate that the electricity used to produce the clean hydrogen is matched to hourly emissions data, and that it comes from renewable energy that would otherwise have not been delivered to the load, or from a generation that began production no more than 36 months before the start of the operation of the electrolyzer. Why this is that it needs to ensure that no fossil fuel derived electricity is used to produce this green hydrogen, and that the existing renewable supply, which would normally be used to help to decarbonize the grid, is not used again for the H2 production. So the process rules must be adapted no later than the 1st of January in 2028. So this is one of the examples that we see also shifting towards more granularity on a local level. Moving on to voluntary reporting initiatives. So while mandatory reporting is becoming more detailed, voluntary reporting initiatives are also undergoing significant changes. Starting with the Greenhouse Gas Protocol revisions. So the Greenhouse Gas Protocol is the global standard for measuring emissions in both the public and the private sectors. And currently, the GHG protocol is considering revisions to several aspects of its standard, including Scope 1, Scope 2, and Scope 3. So the results of the first survey and proposal submissions for the Scope 2 revisions are published. And currently, Scope 2 employs two distinct methods, which is reporting-based, location-based, and market-based. And the survey responses yielded different perspectives on updating the Scope 2 reporting standards. Overall, we see that opinions varied on the dual reporting requirement of location-based, market-based, but some recommended maintaining this dual reporting with some modifications, such as more granularity, while others favored only one method. Stakeholders also debated the need to create more granularity of time and location. So for the reporting, so it is argued that detailed data tracks emission reductions much more accurately and may improve the inventory and system-wide emissions, while others preferred a more broad approach, maintaining more flexibility to accommodate organizations of all kinds of sizes. So this focuses more on emission reduction effects from buying the clean energy from grids that are more dirty, are dirtier than buying the electricity from a grid that are cleaner. However, with this approach, concerns arose also regarding the compatibility of data, the accessibility and implementation challenges of this approach. To continue on this discussion, we've also seen that the ISSB has introduced two important standards this year in the voluntary landscape that help companies with reporting their sustainability efforts, especially when it comes to climate-related risks and opportunities. So it includes two kinds of standards, which are IFRS S1 and IFRS S2. So one is about, will ask companies about to share details about the risks and opportunities related to their sustainability goals in general. So this could include things like how a company manages its waste or how it's reducing its carbon footprint. And in IFRS S2, the focus is on climate-related risks and opportunities. So companies need to explain how climate issues might affect their finances, like whether they will have to spend more money because of climate change or if they will save money because they're more eco-friendly. And it is worth noting that, so continuing on this discussion that is also happening in the GHG protocol revisions, that the IFRS S2 has faced some criticism due to the deviations from existing reporting practices and some potential complications that they might introduce. So in contrast to current regulations and standards that require companies to report their Scope 2 emissions using both the location and the market-based method, in the IFRS S2, it permits company to opt out of this market-based emission calculation. So the reason for that is that critics argue that the existing market-based approach is flawed for its inability to provide accurate and transparent information. So that could lead to potential misinformation. However, the decision to exclude the market-based from the reporting standard as a whole, being mandatory as a whole, has also garnered quite some criticism directed at the ISSB, since this makes company less responsible for their emissions, because it groups everyone in one area together, hiding their individual actions. So it is argued that instead of totally leaving it out, it will be better to provide more accurate information and transparent information to improve this market-based emissions. This is something we saw, a conversation that we've seen with the ISSB. Moving on to RE100. So we also see stricter reporting standards. RE100 establishes technical criteria that guide their members in procuring renewable electricity and tracking progress to their 100% renewable energy targets. And given the dynamic natures of renewable electricity procurement, the technical criteria require periodic updates to remain relevant. So RE100 has incorporated some significant changes into their technical criteria. The first one is that the RE100 requires members to procure renewable electricity from the same markets in which they operate. And most markets are defined by national geographic boundaries. Regarding Europe specifically, they added this requirement. That is the same requirement that the CDP currently uses, which considers the Association of Issuing Bodies countries as one market. So this new requirement, leaves out Poland, UK, Albania, Bosnia, Macedonia, Bulgaria, and Romania out of being the same market, as it's not part of the AIB. A second important requirement that became stricter is that the RE100 technical criteria introduces a 15-year commissioning date limit on the facilities that members claim their renewable electricity from. And this new requirement will require companies to disclose their precise production assets included in their supply tariffs. And the limit will only apply to purchased electricity and not on self-generation. So the reason behind this proposal is that the RE100 would like its technical criteria to further support the procurement of renewable electricity, which adds like in reality new renewable energy source capacities to the grid, and therefore the 15-year commissioning date limit. According to the proposal itself, while older renewable generation is still an important resource for the grid, procuring from it does not directly change the grid mix. So this is one of the examples of stricter reporting standards. So in the end, the key message is that change is happening. So these changes have the potential to alter lots of the market dynamics and increase the reported carbon inventories due to stricter requirements. But there's also still a lot of uncertainty in this voluntary space. So as organizations navigate through this shifting landscape, it's crucial to stay informed, adapt to the changing requirements, and remain committed to environmental responsibility. Thank you.
Amazing. Thank you, both of you, for your inputs and expertise. They were both brilliant presentations, and I think, yeah, it's given a very good overview of what's going on, both here and overseas. We've got a couple of minutes left. I'm just going to finish off by kind of making one final point and returning to the kind of key question of this webinar, which is how can businesses prepare? So as we could kind of see from both presentations, there's a lot of developments taking place, both in Europe and in the US. And it's very dynamic, it's a very fast changing area. So it's very understandable that businesses may feel a bit lost. So there's two kind of key things that businesses can do to ensure that they are kind of ready for these changes. The first one is digitalizing their energy and emissions portfolio. And the second one is kind of understanding their risk exposure to more granular energy and emission standards. And at FlexStyle, we also kind of offer digital tools that help businesses with both of these actions. So I can quickly mention them as well as we go through this. So firstly, many businesses can come across a lot of challenges with Scope 2 reporting for a number of reasons. The most predominant is that they don't actually have a kind of streamlined and efficient process for inputting and uploading all of the relevant data that they need for reporting. So Excel spreadsheets are still actually very kind of widely used across many industries. And this means kind of spreadsheet sharing across global teams, which kind of particularly for businesses with a lot of facilities and complex energy portfolios, that can lead to errors and inefficiencies, and it can also be unnecessarily resource intensive. When you've got kind of a lot of people on the ground, there's a lot of manual data collection, consolidation, and verification. So inventory management tools like FlexStyle CFE Inventory can hopefully simplify this process for you and increase confidence in the accuracy of reporting. So how do tools like this work? So what we do at FlexStyle with inventory is that we collect, well, either the kind of the business already has the data, or we can collect the Scope 2 related data on our client's behalf. So this includes consumption data, production data, CO2 data, and EAC data. And this comes from a variety of sources and issuing bodies that we've kind of built relationships with over a long period of time. So we currently have the capabilities to collect data in 22 countries across North America, Europe, and the APAC region. And we're growing this out to 35 countries by the end of 2024. And all of this data then gets aggregated into our CFE inventory tool. And this allows for kind of one single source of truth where multiple people across your business can access whatever they need for their energy and emissions portfolio. And in the tool, we actually present the data in easy to digest graphs, but all the information can easily be output according to the client's needs. So we can export it as an API, and it can be downloaded into the client's own ERP or ESG system. So this really kind of increases its utility for reporting. And then secondly, the other point I wanted to make was about risk exposure and understanding your kind of risk exposure. So we saw a number of examples in the presentation there of guidelines and standards that may be beginning to favor a more granular accounting system. So a lot of the responses to the GHG protocol were asking for more granularity, and there's also kind of independent laws coming into play like the NYC local law and the H2 laws that support more of an hourly approach to electricity emissions reporting. We ourselves can't predict exactly what kind of the outcomes of the GHG revision are going to be, but the fact they're even doing the revision and there's been a lot of kind of investment into this revision tells us that there will be some changes and these will have implications on businesses. So it's therefore a good idea for businesses to start analysing how their current electricity contracts are performing on more granular criteria, so they're aware of kind of risk exposures if standards do change. So we recently conducted a study where we actually analysed companies' market-based emissions using requirements that more closely reflect the physical reality of the grid. So this included kind of stricter boundaries than the ones currently used by the GHG protocol in their Scope 2 reporting guidelines. So the current protocol guidelines have a market boundary requirement that allows for trading of renewable electricity contracts across whole continents, so the whole of US or the whole of Europe. And we modeled if this requirement was restricted to just being able to trade contracts from a known asset within your own country. And as kind of most electricity grids are national. So yeah, electricity can't flow across the whole continents. And what we found was quite striking. So respondents kind of reported less than half of their emissions using current Scope 2 accounting approach, if we compare this to a more granular Scope 2 accounting principle. So using that kind of more refined market boundary. And we also found that 42% of respondents who claim zero market-based emissions using current Scope 2 guidelines actually have not signed any electricity supply contracts that can meet more granular requirements. So yeah, the key message here is that it's feasible that businesses might find that contracts that they can currently use to claim 100% renewable energy actually, yeah, could end up becoming kind of redundant in a few years. So our CFE diagnostic tool helps businesses gain a better understanding of how their contracts are performing. And it works by taking a few simple inputs like your electricity contracts, where you're procuring from, how much electricity is being used, and what your consumption pattern looks like. So this is all information that you should already kind of easily have available. And from this, our algorithms can assess the electricity emissions attributed to your consumption on different metrics. So we can look at it on annual reporting metrics, the standard guidelines that are used right now, and also on a kind of hourly 24/7 metrics, which is a more granular approach, and also using an emissionality methodology. And it was actually some of the results from this that meant that we could do our study. So we actually offer a free trial of diagnostic, where you can look at one of your countries of operation today. So you can click on the link which has come up if you want to have a go. And this can give you a kind of flavor of the kind of information that you can track using this tool. So with that, I am going to close. Thank you everyone for joining us today, and thank you so much, Joanna and Annie, for your time and expertise. We only really have about a minute left until the end of the session, so I think there was one question that came up during the session. So should we just take a quick look and see if there was a question that came up for Annie from Alison McKay saying, do you expect that criticisms to result in change? I believe that was to one of the earlier reporting standards. Annie, I don't know if you are able to answer that.
Yes, so yeah, thank you for your question. As I explained before, we've seen some critics about the current way the standards are defined. Looking at the revisions of the GHG protocol, actually, the GHG protocol got a 10 million funding for this process for revisioning the standards of including Scope 2 and Scope 3. So also including all those developments that we see in the mandatory world, those local laws that are changing, becoming more strict, the standards that are adopting new kinds of methodologies to calculate certain emissions. It is everything is pointing that there is going to be a change, and there is. I think like one of the most, one example that I want to give to say a little bit more about that is, the GHG protocol got a 10 million funding to further work on this change. So either you believe that this is the end and nothing will change, or it will become different. How it will change, we don't know. But I think this is there are really good indications that change is happening.
Amazing. Thank you very much, Annie. And there are a couple of other questions here, which I believe may have also been for Joanna. So we have from Mikhail, was there any reference on using RECs for Scope 3 on behalf of suppliers located outside US EU? Joanna, do you want to take that question, or Annie?
I wouldn't be able to answer that one.
Okay.
But I could answer the one on ETS, on ETS2.
Amazing. Then we can go with that one. So yes, this question here, how's the source of electricity going to be considered for reporting emissions from electric vehicles once transportation is included, EU ETS too? And does the time of charging impact this, or is it only based on electricity procurement?
So basically, it's an annual reporting. The time of charging doesn't change much. It's simply put it.
Okay, brilliant. Then one final quick question that I believe, Annie, you'll be able to answer as we are now over time. But who is required to report Scope 2 emissions in the US? Just publicly traded companies?
Yes, so if it's related to the SEC climate disclosure rule, which is the US rule, it only includes publicly traded companies. However, the companies are divided in different segments based on how big your company is, what the value is of your company. So there are like different segments of where your company belongs to, and based on that, you're required to be phased in for the reporting. So the large filers will start reporting in 2025 for 2024, but the smaller publicly traded companies will do that later.
Amazing. And there's actually only one more question that I can see, so we may as well go for it, which is, for a European company domiciled in the US with US assets, what are the reporting requirements?
So this is also a very good question. What we see now is for sure the SEC disclosure rule. But as I said before, this is still a proposal and needs to be finalized. What are the reporting requirements? We see that a lot of local regulations also have certain reporting requirements. So it's very dependent also where your US assets are based. For example, if it's an asset in New York, you will fall under the New York local law. But for each region, for each sector, there are different regulations. But for the US in general, it will be the SEC once it has been implemented.
Okay, amazing. Brilliant. Well, I guess we should now wrap up. Thank you guys both so much for your time. Thank you everyone who's joined us today. It's been hopefully an enlightening session for you guys as well.